Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of the today's video is basically discussing the benefits of a holding company. Basically I'll discuss how I saved about $30,000 from taxes using a holding company structure. So we'll discuss here all these benefits of a holding company. First of all, business owners and shareholders are always laser focused on making sure their enterprise is growing and profitable. While steering our business day to day operations is the primary focus of an owner, protecting that business assets come in close second. While there have been various that have been created to accomplish this goal of protecting our business assets, one of the more popular asset protection strategies continues to be creation of a holding company. So first of all, we have to clear our concepts about a holding company. That basically what is a holding company? A holding company's job is to hold the controlling stocks or membership interest in other companies. Or put another way, the holding company owns or holds and controls the assets of the subsidiary companies, its parent's business entity, commonly a corporation or a limited liability company. That isn't a typical business. It doesn't make anything or sell anything. The subsidiaries of a holding company are the entities that actually take part in manufacturing, selling products and services, and carrying on the typical day to day operations of an enterprise. These subsidiaries are often referred to as operating companies. The holding company can own 100% of its subsidiaries, or it can own a portion of the subsidiary, usually enough stock or membership interest to control the subsidiary. When there are several owners or shareholders, a holding company might have 51% of the ownership interest. In situations where there are many owners, the holding company could have a much lower ownership interest and still retain control of the subsidiary. So, because the holding company usually owns a majority shares of all the subsidiaries, the holding company can dictate the day-to-day operation of the subsidiaries, including electing and or removing corporate directors and other managers, and can make major policy decisions on the behalf of the subsidiaries. While the individuals in charge of the holding company can direct the activity of subsidiaries, they normally do not participate in the day-to-day operations of the subsidiaries. So how a holding company is used? Discussing about this concept, some of the well-known publicly traded corporations are actually holding companies with a diverse range of subsidiaries. Instead of existing as one corporation with several divisions, the business is structured as one holding company with several subsidiaries. Lest you think the holding companies are only for sophisticated multinational companies, corporations, small businesses also organize as a holding company, including many self-employed entrepreneurs. So for example, say an attorney wants to start a business providing legal services. The attorney decides to form an limited liability company for the legal services business. Schedule C on the form 1040 would be used to file this business tax return. Will refer to the first LLC as an LLC 1. After a couple of years of renting an office space in a local professional building, the attorney decides to relocate to a building that he or she recently purchased. After buying the building, the attorney creates a second LLC completely separate from the legal service business that would own the recently purchased building. We'll refer this to the second LLC or LLC2. There are now two business entities. LLC2 owns the apartment building, while LLC1 would serve as the holding company that would own LLC2. The legal services business provides a steady cash flow to the attorney over the next few years. The attorney then decides it's time to look for another business to invest in and decide on a fast food restaurant franchise. The attorney sells share in a holding company LLC1, then takes money from selling those shares and purchases the restaurant franchise, which is structured as the third LLC or limited liability company 3. The attorney can continue creating new subsidiary LLCs under the holding company for each new subsequent investments. So, what is the benefit of a holding company? The main question, the main topic is here. Here are several reasons why holding companies are used, continuing with our legal services business as an example. First of all, its benefit is it gives liability protection. When an attorney formed his legal services business, organizing as an LLC ensures that creditors and claimants from the potential lawsuits cannot go after his personal assets to satisfy their creditors or lawsuit judgment. So, holding companies also offer advantages for their operating entities. If the attorney in our example keeps adding operating subsidiary LLCs under the holding company, placing each operating entity and the asset is now uses it uses in as separate entities provides a liability shield. The debts of each operating entity also belong exclusively to that subsidiary. A creditor of one subsidiary cannot touch the assets of the holding company or another subsidiary to satisfy a debt. So the second benefit is further discussion on the liability protection. LLCs and corporation can help a business owner protect their personal assets if the business runs into trouble and gets sued. Uh, but while a business owner can protect their personal assets from creditors and potential lawsuits, can anything be done to help protect business assets? How can you protect both your personal and business assets from creditor and lawsuit judgment? This is where the holding company comes into play, an operating entity that uses and possesses a business assets on daily basis but does not own the asset, and a holding company that actually does own the assets. Other benefits are, while a liability protection may be the most important feature of a holding company, there are several other advantages that this type of the business structure can provide for its owners. First of all, control more subsidiaries for less money. If we will discuss about this point, a holding company can control the day-to-day activities of a subsidiary without owning all the assets or memberships interest. The holding company simply needs to own a majority of the assets or voting interest. This allows the holding company to own the subsidiary at a lower cost than if it had obtained 100% of the subsidiary's assets or voting interest. Then, favorable debt financing cost. A holding company can use its combined balance sheet, which may include multiple subsidiaries, to obtain a loan or for use by only one of the subsidiaries. The holding company would likely get more favorable loan terms that if the subsidiary had attempted to secure that secure operations of that subsidiary. And then we will discuss day to day management is not necessary. The subsidiaries obviously need management to run the day to day operations of that subsidiary, but the management of the holding company often does not need to be involved with the holding company on the day to day basis, and does not even have to be experts in each subsidiary industry. While holding the while holding companies have the aforementioned advantages, there are some trade-offs when using this type of the structure. First of all, ongoing legal and compliance cost. Each holding company must first be created as a distinct legal entity using an LLC or C corporation. This involves paperwork, filing cost, and ongoing maintenance. Even though holding companies are normally not operating entities, but they still usually have to fix tax returns both at the federal and state level. Dealing with minority owners, one of the advantages of the holding company not needing to the own all of the subsidiary ownership interest can also be a disadvantage. When a holding company does not own 100% of a subsidiary, it will need to work with the minority owners if the interest of the minority owners are not the same as those interest of the holding companies. So, what are the holding company taxations? A holding company and its subsidiaries, as previously mentioned, are completely separate business and legal entities. As such, each entity files its own tax return and pays its own taxes on its own income. So, first of all, we will discuss as such each entity filed its own tax returns and pays its own taxes on its own income. The IRS has ruled in place to deter parent and subsidiary companies from moving taxable income around among each other. Starting in 2013, an international subsidiary cannot use American intellectual property AIP without paying the parent company. A parent company is not liable for subsidiary taxes only if it's obvious that two are the operating independently. If the IRS sees that two companies are actually one, it will ask for the back taxes. So, here we will discuss strategies in deferring taxes. Many shareholders create a holding company for each shareholder in your corporation can give flexibility to the each shareholders. So the each holding company controls the dividend payment to each person. Then splitting income. The holding company can be owned by more than one person. This allows the dividend payments and taxes on them to be divided. Create a trust. The shares of the company can be helpful in a family trust. You, your spouse, your children, and your holding company will benefit from this arrangement. Dividends can be distributed to your holding company as a beneficiary, and they are usually tax free. Creditor protection. Profits from your company can be sent to the holding company in the form of dividends, and they can be sent back to the business if cash is needed. Any profits will not go to creditors but will stay within the business. Retirement funds. The assets within your holding company represents type of pensions that you can use once you ready to retire. So beware of the personal holding company trap. As mentioned in the first section of the article, a holding company can serve legitimate purposes by helping to organize subsidiaries, providing liability protection for those subsidiaries, and offering several tax planning opportunities for the owners of the holding companies. If your holding company is organized as C corporation, however, you should be aware of the personal holding company tax trap. So what is a personal holding company? As personal holding company, PHC is a C corporation is which more than 50% of its outstanding stock is either directly or indirectly owned by five or fewer individuals, and which earns at least 60% of its adjusted ordinary gross income from passive sources, because the top corporate tax rates have been historically lower than the top individual tax brackets. Shareholders from C corporation try to keep retained earnings within the corporation to get taxed at the lower corporate rate. So instead of distributing these earnings to the shareholders and getting taxed at a higher individual tax rate, to prevent shareholders from shielding a corporation's earning from the higher individual tax rates, Congress enacted a penalty on C corporation that meet the criteria for a personal holding company. So what is a personal holding company tax? The personal holding company tax, PHC tax, is levied on the undistributed income of C corporation, whose primary purpose is to serve as a tax shield for passive income. For many business owners who use a holding company for our purposes of the liability protection of active business operations, the PHC tax usually never comes into play. On the other hand, the PHC tax is aimed at closely held corporations that earn a substantial amount of income from the investments, such as interest, dividends, rents, and royalties. Avoiding the PHC tax. C corporations should monitor their accumulated earnings throughout the year and the type of the income that are earned to support potential exposure to the PHC tax. Here are some strategies to avoid the PHC tax. First of all, you have to increase the number of shareholders. The PHC tax only applies to C corporations that have more than 50% of their stock owned by five or fewer individuals during the last half of the tax year. So to avoid being labeled as a PHC, you could see if there's way to make sure the top 5 owners of your C corporation own less than 50% of your outstanding stock. One solution could be to gift some of the corporation's stock to family members. Keep in mind, stock owned by certain family members like your spouse or siblings could be considered as owned by you. Be sure to get professional advice if considering this approach. So then we come to increasing business income or decrease the passive income. Your C corporation is only subject to the personal holding company tax if at least 60% of your corporation's adjusted ordinary gross income is considered as the PHC income. You can do several things to decrease this ratio to the 60% ratio. Either increase business income for a particular tax year by accelerating year end sales, or postponing expenses or cost of goods sold purchases. Number two, invest in other operating activities. By investing in other operating activities that yield additional revenue that is not considered as your personal holding company income. Number third is decrease the personal holding company by either converting securities that pay dividends to the securities and that do not pay dividends on a regular basis, or the issuing dividends to the shareholders. Converting to an S corporation may not be the answer of how to avoid PHC tax. While the tax tax is only levied on C corporation. Converting your business from a C corporation to an S corporation may also result in a tax on the excess passive income. An S corporation that has earnings and profits from when it was a C corporation and has more than 25% of its gross receipts from PLC income sources could be hit with a 35% taxes on the excess investment. So hope this video will be very beneficial for you. So do subscribe my channel for more helpful videos. Thank you.